What's up, everyone? My name is Ale. Welcome back to my world of stocks, and welcome back to my 3 stocks on sale series for the month of November 2023. In each episode, I try to find you guys 3 new stocks that I think are trading on sale at today's prices for the long term. And to make things a little more fun and interesting, I specifically choose one low risk, one medium risk, and one high risk option for added variety. As always, though, please do your own research and make your own decisions. I'm not telling you what to do. I'm just sharing my opinion on stocks that I think are looking attractive, stocks that maybe should be on your watch list as well. So if you appreciate all the hard work that goes into these videos, then please consider subscribing to the channel to help keep my channel up and running. It means a lot to me, and thank you for all that support. But let's not waste any time, guys, because I've got some 3 very fun stocks to look at in this month's episode. All 3 of these stocks are down quite a bit, and I think they are looking very attractive at these lower prices. So let's jump straight into them. All right, and starting first here with the lower risk option, you know what? This month, I'm going to go with Snap-on, ticker symbol SNA, which may not be a very popular stock to talk about on YouTube these days, but I actually think that they don't get nearly enough the attention and respect that they deserve, because this is a large, reliable, and in high demand business that we're talking about here, as they sell all kinds of tools and equipment that other companies depend very heavily on, as well as the services that go along with all of that, including diagnostics, repair information, and other system solutions. And really, you'll find those Snap-on products and services being used across a wide number of different sectors and markets, including the government and military, natural resources, mining, agriculture, aviation, and aerospace, and even vehicle dealerships in the repair centers. And because they are so heavily relied on by those other companies in various markets, it's a business that I just don't think I'll ever see disappearing, which is why their financials have been so strong over the years. Now, there was a slight dip during the 2020 recession because of all the businesses and factories that were forced to close down during the pandemic, but to only record a 4% drop in sales given how much they rely on businesses being operational, that's pretty freaking impressive. And having quickly recovered the year after back up to a new record high on nearly 20% growth, followed by their typical mid-single digit growth expected in the coming years, I think it just shows how resilient this business really is. And sure, that may not be as high growth as some of the more exciting tech stocks out there, but again, that isn't really the point of this lower risk option. We're mostly looking for stability here, and yet you actually still find some decent growth too in their very attractive growth-oriented dividend, which doesn't yield too much at just a bit over 2.5%, but any of you dividend growth-minded investors out there will love the low payout ratio, the double-digit growth rate of nearly 15%, and the double-digit growth history. Combine that with a very reliable and strong performing stock price that was actually dragged a little lower recently on a dip, leaving it trading a little less than the midpoint of its 52-week range and well below the sector median on a PE ratio basis, and I think you've got one heck of an investment option here that combines both value and even some reliable long-term growth. Speaking of which, I know that a recession is on everyone's mind right now, and I'm sure that would drag the stock even lower from here, but there's also reason to think that it could potentially be avoided, and at least in the case of Snap-on, they seem to not be experiencing any headwinds at all right now. In fact, in a recent interview with CNBC to discuss the latest earnings report, Snap-on CEO not only said that they're not seeing any signs of a recession, but instead, they're actually experiencing record high profitability and are likely entering a golden age of auto repair as new, more complex cars are requiring new tools and services that Snap-on provides. And the same goes for their military and aviation businesses as well, which I strongly agree with, by the way. I definitely think that autos are only going to become more technologically advanced as time goes on, especially when you look at AVs and EVs, autonomous vehicles, electric vehicles, smart cars, connected cars, all that kind of stuff. And the same goes for virtually any other industry out there too. I only think things are going to grow in complexity, and by the looks of it, Snap-on will probably be playing a major role in all of this. So I think it's a fantastic long-term investment. I don't personally own the stock myself yet, but it is one of the highest stocks up on my watch list. And I'm just giving you the heads up right now that it will probably be in my portfolio very soon because I am very tempted to start buying, especially the more that it falls here. I think it's turning into a fantastic buying opportunity. Okay, now one stock though that I think has already been dragged down way lower than it ever should have been, and I'm scooping up shares of it while I still can, well, that's going to be our medium risk option of the month, which is the entertainment giant Disney, ticker symbol DIS. Now, I know that I've talked a lot about Disney recently, but I just think that this is such a steal of a price that it's sunk to right now because of headwinds that I do think will slowly go away, with some major tailwinds developing right now that can also propel the stock much higher over time. So let me just quickly explain why I think all of this. Now, first of all, the stock has now crashed by more than half of its entire value at over a 60% drop, leaving it at just about the lowest price in a decade, which is pretty mind-blowing considering how bad the pandemic lockdowns were for them, and yet it's actually trading lower today. That's really crazy. Now, I will admit that there is some good reason for that crash, as the pandemic itself caused giant damage to their business, resulting in its first annual loss in over 4 decades. The cable cutting movement continues to hurt their linear TV business, which is also being hurt by the weak economy and lower advertising spend from companies. Their transition over to streaming is still not yet profitable and is pretty far away from offsetting that damage that is being caused to their TV business. And there's been a ton of political drama too surrounding them, which has also polarized or alienated much of their fan base. And as if all of this wasn't enough, they even had to deal with a writers and actors strike in Hollywood that delayed a bunch of their movies and TV shows, which they desperately need right now to help offset everything else that is hurting the business. But in my opinion, all of these headwinds are presenting a great buying opportunity for a turnaround play, as I now see several tailwinds starting to form. For one, the historic writer's strike has finally ended, which means Disney can start pumping out their content once again. I mean, just Marvel alone should have a pretty big wave developing soon, and Star Wars has like 10 movies and shows already in development, although it will admittedly take some time to develop new characters and backgrounds for both Marvel and Star Wars. But over time, I do think that you'll see that transition start to take place, and they'll start to fuel their streaming services in a large way once again too, which Bob Iger, by the way, returned as CEO almost entirely for, to make sure that it happens successfully and that they make streaming profitable by sometime next year, which I actually think that the recent price hikes and ad-supported versions will help them surprise analysts who are lowballing estimates and don't think it'll happen. Speaking of which, their next quarterly earnings report is also coming out in about a week or two, and even as soon as that, I actually think that there's solid reason to believe that they'll start surprising to the upside there as well. Because not only are expectations already super low for Disney, but if you actually take a look at the recent earnings report from rival Comcast, you'll see that they not only narrowed their losses for their Peacock streaming service, but more importantly, they also saw huge growth in their theme park segment of over 17% on sales and 20% on profits. Now, granted, that was likely boosted by the successful launch of Super Nintendo World at Universal Studios recently, but in the theme parks and kind of resorts markets, when you see one giant outperform, it's usually a good sign that consumers are out and about and likely visiting all the giant players in the space. And given that Disney is the largest in the world, I think they stand to benefit greatly from that too. In fact, keep in mind that theme parks only makes up around 8% of Comcast's total sales, but for Disney, it's not only their largest segment, but it's also their most profitable one too. So if they come out with better than expected results in the next quarter for that segment, it'll likely be a huge deal for the company as a whole and the stock. And so if you add up all these turnaround kind of tailwinds with a beaten down stock valuation that has left it trading at just a PEG ratio of less than 1, which is a great value on its own, but it's also 37% cheaper than the sector median of 1.5, well, I think you've got one heck of a value stock right here. I mean, just think about how crazy this is for a second. We're talking about a market cap now of less than $150 billion. Do you know how absurdly cheap that is? Just take a look at Netflix, who only does streaming. That's literally all they do. And yet that alone has gained them a market cap of over 180 billion. That's 30 billion more than Disney. I'm sorry, but there is just no way that Netflix should ever be considered a more valuable company than something like Disney, who in my opinion has much stronger brands and is a much larger, way more diversified business. And to think that Disney is now trading at a market cap of less than 150 billion, I mean, to give you some perspective on this, we know that Microsoft recently acquired Activision Blizzard, just a single video game company, for 70 billion. You double that and you've got the value of Disney there. To think that one of these giants like Microsoft or maybe Amazon or Apple could just flat out buy Disney if they really wanted to is insane to me. Now, granted, there'd be regulatory pushback and I'm sure other roadblocks, but at a market cap less than Netflix, it just doesn't make any sense to me. It is way too cheap at these levels, and I gotta think that the stock has to rise over time. Now, granted, there's a ton of headwinds. I totally understand that. And, it's going to take time until Disney can correct some of the issues that they're going through and maybe win back a lot of their customers. The stock could definitely go lower from here, especially if there's a recession or other macro issues that hurt it even more. But at these levels, I just think long term, I'm not going to regret picking up the stock at these prices. And the more that it falls, it just gets more attractive to me. So I'm picking up the stock and, we'll see how it goes. But I'm pretty optimistic for the longer term on it. All right, guys, it's time now to finish up, though, with the third and final stock of the list, which is also our highest risk option. And you know what? This month, I'm going with another stock here that's similarly to Snap-on. It gets rarely talked about these days, but I actually think it's worth taking a much closer look at. And that is American Tower, ticker symbol AMT, which is actually a REIT, a real estate investment trust. And if you don't know what those are, they're basically companies that own real estate and various other assets who then lease them out to collect rent or other fees, which they in turn use to pay out a large portion of that income out to shareholders of the stock, usually in the form of an attractive dividend, which in the case of American Tower, their dividend yields about 3.8% with some excellent growth metrics on it too, like a nearly 16% growth rate and over a decade of consecutive increases. Now, REITs have actually been super volatile in recent years, mostly because of the retail apocalypse as well as the pandemic, which resulted in more businesses closing down and even people staying in to work from home, which of course, as you would expect, it sent demand for office real estate crashing, and of course REIT stocks, right along with it, which even in the case of American Tower, it too has seen a recent dip of over 40% from the top. However, in their specific case, I actually think it's not very warranted and it's leaving behind a pretty attractive entry point. See, AMT's clients have practically nothing to do with retail or office buildings at all. Instead, American Tower specifically buys up land to build cell towers on them, which they then lease out to mobile carriers like AT&T, Verizon, T-Mobile, and more. All three of those, by the way, the biggest carriers out there, they just recently signed new multi-year contracts with American Tower too. So the business should be even more secure going forward, which is already at a gigantic size with over 225,000 locations worldwide across 25 different countries. And with the rise of smartphone usage, internet usage, work from home, online shopping, the Internet of Things, smart cities, cloud computing and data centers, artificial intelligence, smart cars, I could go on and on. But with the rise of all those things, they're going to need, the use of cell towers, and I think that's only going to increase over time. In fact, according to Statista, mobile data usage alone more than doubled in size since 2020, and it'll likely double again in the next couple years. Now, granted, satellites, something that may be becoming a rising threat in the future, but I still think that we're a long ways away from those proving to be a more reliable alternative to cell towers. And, with the stock already beaten down by so much, which, by the way, I can't really even give a good reason for that other than maybe their growth is just slowing down a bit in recent years. But you also have to keep in mind, there's major headwinds in the telecom industry right now. You see the big telecom giant carriers all of them are experiencing some of the worst growth that they've seen in years. And even their stock prices, some of them like Verizon and AT&T are trading at decade lows. So for American Tower to actually still be breaking new record highs on revenue every single year, despite the horrible macro environment, I think it just shows how resilient their business are and how badly they're needed, which because of how hard it is for a large carrier to move all of their equipment over to a rival provider after having already installed it on AMT's towers and land, they've also been able to maintain a super low churn rate of only around 2%, which means that when AMT gets customers, they tend to stick around with them and really pay whatever rising fees and upgrade costs that they have to because it's just cheaper that way. And because AMT adds multiple carriers to single locations, they even benefit from stronger profit margins too, which are typically around 70% or more and quite a bit higher than the sector averages. Overall, it's a very attractive package, and really the only reason why I haven't bought American Tower stock yet myself is because I've just been putting more of that money towards Verizon, who has a bigger dividend and also gives me, exposure to the wireless technologies market, which I admit is very high risk at the moment because the macro economy is very weak and there's just not a lot of growth or new business to be had in wireless at the moment. But, I do think that that's going to turn around over time. And so the more that, I see a stock like American Tower falling, the higher it climbs up on my watch list and the more I want to pick it up, which I might do soon. It's very similar to Snap-on in that sense. Both are very high up on my watch list. I think I like Snap-on a little more. To me, it's a little safer, but both of them I think are great choices to be adding to a portfolio. So anyway, I included them this month. Let me know what you think about these stocks. I'd love to hear your thoughts down below. Do you own any of these stocks? Do you like any of them? I'd love to hear your feedback and let me know if there's any stocks you're buying. I may include them in a future video. But thanks again for stopping by, my friends. I hope you're all doing well out there, and I will catch you in the next video. Take care, everybody. Bye-bye.